kind of a choppy trading period over concerns about tariffs and other things. Our next guest looks for stocks that have limited tariff exposure and a record of navigating uncertainty. Let's go to Justin Elliott, portfolio manager at Caldwell Investment Management. Thanks for joining us today.
Thanks for having me on.
So we saw some retail earnings today, some of the big ones. Target missed estimates, cut its outlook. TJ Maxx beat and delivered a weaker outlook. How are you looking at consumer spending for the second half of the year?
Yeah, we've had a lot of numbers come out now. I think for a while that the consumers have been stretched, right, by the inflationary period of 2022 that sort of continued on to today. And a lot of consumers are tapped out, automobiles being much more expensive than they were pre-COVID, clothing, even groceries. So the consumer is very much tapped out. We're hearing a little bit more caution from even some of the more non-discretionary players, I should say, like Walmart, right? And Costco in their discretionary category. So I think consumers are more focused on just having those essentials covered and really cutting back on some of that discretionary spending. So I think we could definitely expect more of that in the second half, especially depending on how these tariffs play out. People might just hold steady for a while.
So it basically sounds like people are going to shop, but they're not necessarily going to pick up as much as they normally would, scaling back on what they can. When you look at the current situation, do you think the Trump administration will allow prices to trend higher, considering they're trying to sort of appeal to that same group of people?
Yeah, it's interesting because, 1Q earnings, for example, at the index level, they held up pretty well. And I think what we heard from a lot of companies was that consumers, and their customers were kind of buying ahead of tariffs to try and, get ahead of those price increases. So the comments that we've heard from Trump are, that some of these companies should, quote unquote, just eat the tariffs. I think there's going to be a balance between companies trying to, maintain or grow their market share and maintain or grow their profitability. You can't necessarily do both at one time, especially in kind of a softening economic environment. And so I do think we'll probably see prices go up overall. We know that the end level tariffs are, not going to be zero. They're likely going to be 10%, sort of in the best case scenario. But I think it would be fair to expect higher prices overall for sure.
Okay, so when you take that into account and you're looking at stocks that are limited as a trade exposure or tariff exposure, what are you looking at?
So we like a company, OReilly Automotive, for example. They're one of the largest providers of aftermarket automotive parts in the U.S. They've got about 6,500 stores, and we think of this as sort of a recession-resistant, really maintenance-driven business, right? If you have a car and you depend on that to get to work, if it breaks down, that's something that needs to be fixed. It's kind of non-negotiable. And so they've got a nice split, sort of 50-50 between what they call the do-it-yourselfers. Those are the people that do work in their own garage, do minor repairs there. And then you have the do it for me. So people that take their car to a professional shop. Again, on that necessity bit, as cars become more complex, it's becoming increasingly likely that car owners are going to take their car to a shop to get fixed. And O'Reilly has built out, a very strong logistics advantage and a logistics network to really serve those pro customers, those do-it-for-me customers, much stronger than peers. And so we like the way they're positioned there. Because a lot of these parts, again, are necessity-based, we think that they have the ability to kind of pass along those prices. Consumers don't necessarily have the ability to push back. And so we think in that regard, they're very well set up for the type of environment that we've just been discussing.
You also like Interactive Brokers Group. Tell me about that.
Yeah, so Interactive Brokers is, an electronic brokerage. They operate in about 150 countries, and they basically trade all asset classes. This is a company that is very much a tech-forward leader in their space, and they have tried to make it easy for, other brokers, other banks that want to implement a trading platform to come to Interactive Brokers and just basically use their white label product. It takes a lot of effort to go to new jurisdictions, make sure all of your compliance is in order, and really get that set up. So Interactive Brokers has been growing their accounts quite nicely as a result of this, right? You've got that outsourced part of the business where banks are looking to adopt their service, but you also have international investors that are looking to get more exposure to U.S. equities, for example, and it's very easy to do on Interactive Brokers platform because they offer such a wide variety of assets and access to different exchanges, I should say. And that's been a real key driver of their account growth. So longer term, they think there's about 80 million sophisticated investors globally, and they only have about 3 million accounts right now. They're much smaller than a Schwab, for example, or an Ameritrade when it comes to kind of the accounts that they have. And so we think there's a long runway for them to continue sort of growing that account base and then leveraging kind of their tech expertise and their low-cost leadership to drive margins higher as well.
Okay, the other pick you have is UL Solutions. They do certification. Can you sort of tell me a bit more about what they do?
Yeah, absolutely. I think this is sort of one of the lesser known names out there. They do inspecting, testing, and certification. And what really drives this business is increased regulation. You can think of, food, pharmaceuticals, consumer electronics, for example, that need to meet more stringent regulations globally, right? Whether it comes to kind of where their parts are being sourced from, how it's being put together. You have new product development cycles that also drives this business. And then you have in developing countries, them adopting more regulations as kind of that middle class grows and the economy grows as well. And so we see these sort of three very strong secular tailwinds for the business. As it relates to the current environment, though, supply chain reorganization and broadening out of your supply chain, right? Reshoring your manufacturing, all of that requires more certification and testing for those new plants that are built wherever they're built. And ULS kind of meets the customer where they are. So in that sense, they're benefiting from, this reorganization of supply chains that should drive demand higher. And they're also where the customer is at. And so they're insulated from tariffs in that sense. And so we like the setup for this business longer term, and we think they're very attractively positioned right now to capitalize on just what companies are doing to kind of mitigate these tariffs and reorganize their supply chains.
Justin Elliott, I've got to leave it there with you. Justin is portfolio manager at Caldwell Investment Management. Thanks for your time.